Hello, welcome to the first lecture, Finance 311, an economic overview. We're doing this overview because the business, the company, the firm, and I'm going to refer to businesses overall as the firm, they do business within a broad economy. And finance is used to make decisions. So in order to make decisions, you need to make decisions within the context of what's going on in the broader world. So what we're going to take a look at now is an economic overview of where we are today. Decisions are made within the context of an existing economic environment. It looks at long-term trends, looks at current events and what's happening, and then it looks at the impact of policy. So what we're going to take a look at today, and this is done in two sections, because you'll get tired, you don't want to listen to me for a full hour. So we're going to have a couple of these here so you can come back and do it as you like. I'd like to start with some basic economic assumptions that we all know. But the first one is price is determined by an agreement between a willing buyer and a willing seller. This becomes important because as firms go to price their products, they need to be able to sell them, and consumers need to buy them. And the consumers are the ones that are going to put a value on the product. You may want to sell something for a price, but if the consumer doesn't put that value on it, it won't sell. So that's the first thing. Price is influenced by the relationship between supply and demand. So if supply of something exceeds the demand, that will push prices down. If demand exceeds supply, the price goes up. This includes products, services, and very importantly in today's economic environment, labor. So these are sort of broad economic assumptions that we make when we're looking in the area of running a business and finance. Some of the others that continue is the economy is based on what is happening today. It's measures of what the economy is doing. It's a measurement of society to a degree. So we got the economy is what's happening, data driven. Then I'd like to distinguish between the financial markets. Financial markets include interest rates, stocks, bonds, options, etc. They oftentimes reflect what has happened, but what may happen in the future. Okay, so the economy is what's happening. The financial markets reflect what's happened and what is anticipated to happen in the future. Different people make different assumptions. Thus, we have differences of opinion, and that's what creates a buy and a buyer and a seller. The market often reacts to news before it's digested. It hears a piece of news and it moves ahead. It's also influenced by algorithmic traders, computers, programs that trade based on news, information, and other algorithms. So the market is influenced. So we have to be able to distinguish between what's happening economically and what the financial markets are doing. Both impact the firm. What we're going to look at first, global and U.S. trends, economic measurements and forecast, policy impacts, and the last section, how does it impact you and the work we will do in this course and the firm. So let's start with some global and U.S. trends. There's a couple of things that are that major themes, trends that are happening around the world. And these are sort of megatrends. These are not things that are just going to stop because of a political view or action. Today, the world is interconnected. As we can see here, that since we have technology and the internet, we are connected. We're now interdependent and interlocked as nations, as individuals, in a way which has never been the case before. Think about that. We're interconnected as a world, and the internet connects us. We look at supply chains, and supply chains takes everything from suppliers to the corporation to the customer. And there's a forward and reverse movement of information, products, and funds, dollars, between these different areas. So this is all part of the global supply chain. Where these take place and where products are manufactured, services provided, is all part of a global supply chain. We're not isolated. We don't produce everything in one place anymore. When we look at the next one, and I ask you to take a look at this, you might want to actually take if you have two screens, listen to the lecture and look at this. This is a screen that where our food crops come from. And this is on plant genetic resources. And as you can see, there's different products come from different parts of the world. And so we're connected from a food supply perspective when it comes to certain products and tastes. So we got to keep that in mind. But we're independent on food. The next one is airlines. This happens to be the Boeing 787. And you can see where all the parts are made. And you can see that it starts, the forward fuselage is made in Wichita, mid is in Japan, the center in Italy, the rear in South Carolina, landing gear in Japan, or main landing gears in Gloucester. Engines can either be from Derby, UK, or in Ohio, but look at it, all come from all over. And that's, when you think about this, this is just a broad example. We can look at many products and industry and see how connected they are. And where this comes from is basically cost of labor. Okay, and if you see here in this chart, the cost of labor in the U.S. runs about $37.71. In Germany, it's more. France, it's about the same. Britain, a little bit less. But take a look at Mexico, $5.90 an hour. So there's different cost of production in different countries. So now let's take basic accounting. Debits equal credits. So if we have revenue, less cost equal profits, cash in less cash out, there's three things. Cash in exceeds cash out, there's a surplus. Cash in, cash out, we're balanced. Cash in less than cash out, deficit. So if we look at trying to move production around the world, we got to realize there's a cost associated with that. And we need to make sure that as the firm is making decisions, what's the best? So we look at Mexico at $5.90 versus $37.71. Even if you put a tariff or something on that, you have to build a plant, you have to do that, it's still going to be cheaper. But think about what happens. If you shifted this labor back to the U.S., that means it's costing more to produce a product, which essentially means a firm is going to have to charge more for the product. And who's going to pay for that? The consumer is. Because remember that basic equation, revenue less cost equal profits. So assuming every firm is going to continue to be profitable, if they have higher costs, those eventually get passed along to the consumer. We look at the global financial system. Everything is tied together. Our financial markets, commercial banks, currencies, exchange rate, all of these together form our global financial system. And this is how we're tied together. But let's take a minute and look at the world population. This is always an interesting chart every time I look at it, but the population of the world is roughly 7 billion people, give or take. In China, there's 1.3 billion, or 20% of the Earth's population is in China. India is 1.2 billion. But look at the U.S. at 307. We're actually relatively small relative to the India, China, but look at how close we are to Indonesia, Brazil, Pakistan, Bangladesh, Nigeria. These are all huge countries. So we have this small sliver. So if you're a business person in the U.S. and you want to grow and you sell a product to consumers, there's a lot more consumers outside of the U.S. than they are inside the U.S. And that's what the future is for most businesses. How do we expand in this global environment? Now, when we take a look at the GDP, we're going to talk about the GDP in a minute, but when you look at it, remember, we only have 5% of the population, but we have 24% of the GDP. So we're the wealthiest country. We produce more, and we look at it on a per capita basis, we produce more. So if we look at Mexico, Canada, relatively small, China, The next biggest, 15. But India, only 2.83. So if you're looking here in India at 1,000,000,002 people, and you look at how much they have of the GDP, this is where the growth is going to happen, okay, in these countries here. And we're not going to see the growth. So this will get smaller over time. And you can see what North America is. Europe is still huge. Asia, Latin America. Taking a look at that, there's some really interesting things here that we can see. Now remember, this is the environment in which the firm is operating. So if I'm looking at what the customer base of a business is, it could be 7 billion, or are we looking at just in the US? So think about some of these things as we're going through. When we look at a contribution to global growth, and we look at it over the past 18, 20 years, you can see that the growth in the world has come primarily from China. So when we look at the growth in the US, the contribution to growth in percentage points, most of the growth in the world has come from China. Okay, we can see that Europe and Japan are small in the rest of the world, but look at where the growth is coming from. The rest of the world includes your Bangladesh, your Pakistan, your Indonesia. So the contribution to global growth is not from the U.S. It's from outside the U.S. The other thing is we're seeing a demographic shift, a major shift in population within the world. Where we're seeing here is we've seen growth in developed countries peaked probably around 2000. And developing countries are where the growth has happened. So we can really see that this growth, if you put a trend line out here, that the growth in developing countries is going to be more than in developed countries. We actually see developed countries starting to decline while developing countries have. So that's the major shift that's happening. We're global. We're having a shift in demographics. A lot of this is what's resulted in this reallocation of manufacturing capacity, is when we see these prices that you saw outside of Germany, France, the UK, and the US, there was availability of new labor forces. In Eastern Europe, it wasn't until after 1989, when the Berlin Wall came down, that this availability of cheap labor in Eastern Europe happened. China didn't open to this until 1997 and became part of the World Trade Organization in 2002. We have Vietnam and Malaysia. So we've had this availability of new labor at a lower cost. So firms, in order to be able to sell product, they need to price it appropriately. So since they're competing on a global basis, production moved to keeping the price to us, the consumer, in a fairly stable way, but availability of new labor force. There was a movement to free trade and regional trade agreements, NAFTA, the Eurozones, and these trends resulted in major economic shifts in developed countries, including the shipping of jobs overseas. Okay? And this was a major shift. But these are long-term trends. This didn't happen overnight. This is a long-term trend. What we're seeing today is a movement in the U.S. back to isolationism and trying to reverse that. But you can only reverse that so much because of the cost. So if the cost goes up, the product will not sell for that price. Okay? So don't forget the willing buyer, willing seller, and what the costs are. So when we look at this, there's major global issues that are connected, and that as much as we look at some of these things, I just take a minute and read through that. Natural resources, look at the issues there. We have depletion, deforestation, we have topsoil erosion, oil depletion. The oil will not last forever. Okay, there's biodiversity issues. There's environmental health, water scarcity, water safety. We are so lucky in the U.S. to have water when we turn on the faucet. That's not true in many, many countries. We're having global climate change, ozone layer changes, glacial melting, carbon emissions. We move on to energy, distribution of oil, gas, and coal. Looking at fossil fuel in the connection, renewable resources, shelter. We're finding more people living in cities. What do you do with waste? Is there enough shelter? Population, transportation, communication. They're all connected. So I think I'm suggesting that probably what we want to do is look at things on a global basis. But remember, these are mega trends that are happening. They have been happening. What I just talked about is not new. This has evolved over a 30-year period. Okay? So these are long-term trends. As much as we'd like them to go away, you can look at the feasibility and will that actually happen. The next issue is aging of America. The number of Americans aged 65 and older will more than double by 2060. If you see this piece right in here, the growing population going from here, where we're just about 46 million here, up 65 and older, in 2040 will be over 80 million, 98. So that's doubling. And when you look at this, I want you to come back here and take a look at this different census. In 1960, 36% of the population was under 18. Then in 14, it was 23, 21, 20. But what we're seeing is declines in ages 18 to 64, and this increase is in the senior population, 65 plus. So when we get out here, just take 2030, you can figure out how old you'll be in 2030, is that we're about equal. This number of children under 18 is going to be equal to the population over 65. Now, this has some long-term issues. People are living longer, healthier lives. There's going to be higher medical costs, no doubt. People are staying in the workforce longer. Second, third, fourth careers. A lot are working part-time as the old way of retiring and dying goes away. You have different lifestyle and buying habits as people age. Most important, there's going to be a decline in workforce. So if you have more people leaving the workforce than coming in, that is a negative, big negative, because remember, to produce goods and services, you need workers. If the worker pool is shrinking, you're not going to be able to produce as much. So you're going to need labor. The U.S. is actually positioned better than other countries. Emerging markets, China and Russia, are actually seeing a declining population. The unfavorable demographics will force the growth rate in China down from 6 to 4%. What will it do here in the U.S.? Think of the implication of this on a business. They're huge. Not only from a worker perspective, but a customer production perspective. What is the person? What can people need? What's going to be different? The other last one on this piece is distribution of U.S. population. If you look, those white, non-Hispanic, 65, 46 in 2050. When we see the Hispanic population going from 16 to 30, 12 black non-Hispanic stays about the same, Asian picks up, and other. But we're seeing this significant shift in race and ethnicity. As we're getting older, we're seeing the population change. These are trends, my friends. This is the mega trends that are happening. We have, in the middle of all this, we have global political change. The growing size and role of developing countries. Expanding leadership role of China. We're seeing a reorder of global leadership. We have the isolationist view in the UK and the US. Development of new trading partnerships. The Middle East, Sunni versus Shiites. Iran, Saudi Arabia. We have terrorism. What is the role of oil and fossil fuels? We have never been at the heightened risk of nuclear war than we are today. So we got this global political change. What we see is the Chinese Party Congress has a number of things. Now that President Li has taken a long-term view, they're going to grow, he's going to reform the economy, and they're stronger. So will they just roll over? Okay. This next, at the beginning of our current president, he pulled out of the Trans-Pacific Partnership. That void that is in the partnership because the U.S. isn't there has been filled by China. Would people rather deal with us? Yeah. But they need to trade where it makes sense for those as a country. This chart here is something that I recently learned about, to be honest, on January of this year, and that is the China Belt and Road Infrastructure projects. What they're doing, if you look at this, the Chinese are making investments all over Africa, India, throughout China, connecting Europe. And what they've made what they have been focusing on is building ports for trade, pipelines to move oil and other liquid, railroads. But look at the belt they're doing. This is really creating an infrastructure to make it easier for these hundreds of millions of people to trade with China. This is what China's doing in their leadership role. I'm not trying to be negative, but you need to be aware that some of these things are happening. So what we have is three things. Demographic changes, shifts, both in population, age, and ethnicity, reshape global power structure, The last thing when we're looking at long-term trend is over the past 10 years or so, we've seen something that has now taken on the word disruptors. And disruptors literally uproot and change how we think, behave, do business, learn, and go about our day-to-day lives. A disruption displaces an existing market, industry, or technology, and it produces something new, more efficient, and worthwhile. So at the same time, a disruptor can be very destructive and at the same time very creative. I think we start out with the smartphone. The smartphone totally disrupted the telecommunications business. It has given us tools, it gives us access to information. It's disrupted the world. Amazon has disrupted the impact. Amazon has disrupted the retail business. There are many disruptors. They can be in technology, transportation, changing use of energy. When we take a look, you can take a look here now at some of the top 50 disruptors. Let's just take a second and look at some of them. The article, Meet the 2018 CNBC Disruptors. When you look at it, you come by and you say, well, these innovations are changing the world. So if we're looking at firms or companies, this can be opportunities for companies, but they can also be threats. So let's just look here. We got space taking the new lead in space. Uber, Airbnb, Didi Chuuk, I don't know, but that's the Chinese version of Uber. Lyft, Grab, another rideshare. 23andMe, a genetics house call. Udacity, nano-degree your way to a new job. Rent the Runway, Closet in the Cloud. Coinbase, TransferWise, look at these Survey Monkeys. Some of them we recognize. Progeny, I don't know what that is. Let's just take a quick look. Fertile ground for disruption. What do they do? Here we're looking at healthcare and fertility. Okay, so what we have a lot of different things, and the firms that you may deal with over your career, some of them will be impacted by these disruptors. So it's really, if we just take a look, you can go back, there's a lot of them we don't know. And it's sort of be aware of these, because this is where the new ideas are coming from. So just take a look at some of them. And there's 50 of them. So now let's go back and say, if these disruptors are going to be here, these are longer term trends that we're looking at. Now let's take a very specific look at what's happening today. Okay, so that are sort of the major trends that we see going on. And these are trends that are longer term trends. They'll take roots. There's not a lot that you can do to stop some of these trends. There's so much momentum behind them, either on scale, size, evolving technology, our desire to do things better. So now we move into section 2, economic growth, and we're going to take a look at measurements and forecasts. And there's a lot of different things that go into this, but we're going to start with the GDP, a common definition that you've all heard of, and we're going to look at it within a slightly different context today. It's a primary indicator of the health of a country's economy. Healthy, if it's growing, there's low unemployment, wages increase as businesses demand more labor, and it builds confidence in individuals. If it's growing too fast, inflation can be a risk. If there's negative growth, there's less jobs, less production, and it creates a negative feel. 2/4 of negative growth is what we would define as a recession. So number one, it's a primary indicator of the health of the economy. When we look at it, it's often expressed as a total GDP. We look at comparisons, prior year, prior month, prior quarter, year to date. Trends are more important, okay? Because you want to see which direction we're heading as to a specific data point. The computation of it is very complicated. It is made up of other statistics and estimates that feed in. So there's a base of assumptions that go in here, and a lot of things that may or may not be covered. It's not always timely. What we're going to see here are the preliminary estimates for the third quarter, which is July 1st through September 30th. And the final will be coming out in the next day or so, and that will revise it. So we're looking at it, think about it as a trend. What is it telling us, and where is it pointing us? When we look at this, we can see here, this is the total gross domestic product. It last was revived on November 28th, and it's going to be revised on the 21st. So you may have looked at this by this time, but I wanted to make sure this was out here for you. One of the key things, and I just want to hone in right here on the second quarter, what we have is annualized $20.66 trillion. And as you can see, personal consumption makes up $14 billion of the 20. So a substantial portion of that. We then look at gross private domestic investment. So that's what companies spend to make things for us. And you can see that number's been growing. It's about 3.7 billion. So consumers consume about 14, the majority of, and if you think of the growth that's happened over the past few quarters, it's been as the consumer spends. We come down here to net exports. It's a negative. It reduces because we're importing it, we're not making it. And you can see that number has gone back and forth, but it's increasing. We'll talk more about that. But if you can tell, it's a relatively small number relative to the $20.66 billion. Then we have government consumption, $3.5 trillion. And that includes federal, where you can see the defense budget going up, non-defense staying also going up, and state and local. So key thing for you to know out of this, the takeaways, number one, it's big. about $21 trillion. $14 trillion is personal consumption. Next biggest one is private investment, making investments to make things for us. Then exports, and then we look at the government spending. So it's more for you to get the understanding of the size of it, and that it takes a lot to move these numbers when you think about it in relative terms. The next one slide that we're taking a look at is this shows the change from the preceding month. So as you can see that we go back to 2005 when we were growing at 4%, drop down, up, down. Here's the Great Recession right in here. We see this coming back. Then we dropped down in 11, 14, went way up. We had a lot of growth, came back down here, went back up, and now we see it coming down again. So the question really is, if we had a straight line, we would see that it's trending up, but there's a lot of movement within it reflecting how it's computed and how short-term effects, what things like weather will affect GDP. I think the thing here is, if you look, the blue is the gross domestic product. This is the third quarter. This is that. And we're seeing growth, heavy growth. But if we look in that would have been the second quarter, we saw growth almost over 4. And that is back down. You can see over the past couple of years that we haven't had that growth, and it's on its way back down. But you can see again, a lot of it is consumer consumption has previously been the driver of all of that growth. So what started happening in here is we've started seeing the growth in private investment. This is people spending the tax cut. But again, this magnitude and what's driving it. Here is I put a trend together so that you can see what has happened with the GDP since 1950. And if we look from 1950 to today, we can see an upward trend. And what you're seeing here is whenever these blue or these gray pieces here have indicated a recession. And you can see how that has dropped down. But overall, over time, we've seen that over basically a 60-year period. When we look at what the forecasts are going forward, what we see is this is out of the projections for the growth rate, the midpoint of the various analysts produced by the Federal Reserve Bank of St. Louis. And what you can see is that up here, we're seeing growth is just going down, down, down. We don't go to a recession. I think that's what it's telling us, is that we're going to have slowing growth between now and 2021 on this forecast, which is the next 3 years. So it's showing a slowing economy. We'll talk about some of the reasons for that shortly. The outlook for growth around the world, if you can see, the world growth was 3.8. This is Goldman Sachs. This just came out. This is a November piece, November 29th. And you can see where they're estimating for 2019 worldwide growth of 3.5, 3.6 in 20. But you can see a lot of that growth overall is coming from the emerging markets, which we previously had talked about. But you can see that the growth in China slows, where we see India picking up. The U.S., again, remains relatively stagnant and declining, as does much of the Eurozone and the U.K., where we're seeing the growth is coming from emerging markets. When we look here at developed markets, and developed markets are areas such as the U.S., Japan, and the Euro area, including the U.K., are developed countries. And that is growth rate when you look at it. We've been at 1.7, went 2.4, 2.4 for this year, then down to 2.1, then down to 1.7. So we're seeing a slowdown. And then in emerging markets, we're seeing a slowdown, but it's a rather stable. It's moving faster. Caution, though, on using GDP, because there's a lot of other things. It reflects what has happened in the past. It's not indicative of what may happen in the future, and it GDP doesn't really capture the positive impact of technology and improvement in lifestyles of the population of the world. So there's a lot of other things what we could look at. We could look at economic indicators. There's a number of them. Environmental and social indicators. We got to be cautious also of forecasting and nowcasting, because we have so much information that's available to us that we can change our opinions fairly quickly in real time. And we have crowdsourcing information that we bring stuff up, and it's changing how our understanding and use of information in the decision-making process in the firm. So that ends lecture number 1. Take a break, go back and take a look at the top disruptors. Then turn it back on and watch Economic Backroom Part 2.